There is a quiet ache many of us carry, a persistent whisper that asks, are we truly building a legacy, or merely casting our hopes into the relentless currents of chance? Perhaps you've felt this ache, a deep-seated frustration with the cacophony of conflicting market information, or the chilling fear of making a costly mistake that could unravel years of effort. For some, this feeling is magnified by the silent weight of past losses, the profound shift after widowhood, or the poignant absence of a secure future for loved ones. These are not merely financial anxieties. They are echoes of the human heart's yearning for certainty, for mastery, for a truth that provides solace and direction. Today, we embark on a journey not of quick fixes, but of profound introspection. We will gently, yet rigorously, explore the singular trait that truly separates the successful investor from the unwitting gambler. It is a trait often obscured by market noise, yet it possesses the power to fundamentally alter your financial mindset and the very trajectory of your wealth. We are here to challenge the consensus, to look beyond the headlines, and to uncover the hidden truths behind wealth accumulation. This exploration is an invitation to demystify the market's intricate dance, to find your true edge, and to empower you with a clarity that grounds every decision in data-driven understanding rather than fleeting speculation. Consider for a moment the vast ocean of finance. On one shore, a vessel of meticulous construction, charting its course with compass and sextant, guided by deep knowledge of currents and tides. On the other, a hastily built raft, tossed by every wave, its crew hoping for a favorable wind, their fate left to the caprice of the sea. Many believe they are on the vessel, diligently navigating, yet find themselves adrift, reacting to every market ripple with a tightening in their chest, a sense of inadequacy. This is the silent struggle, the pervasive confusion between true investing rooted in thorough analysis and intrinsic value and mere speculation, which often masquerades as a sophisticated financial strategy. This confusion feeds the fear of financial loss, the gnawing feeling that you are constantly outmaneuvered, always a step behind. We are not here to judge, but to illuminate. We are here to confront these deep-seated investment biases, to gently peel back the layers of misconception. For within the wisdom of Benjamin Graham, the very father of value investing, lies a singular, powerful trait. It is a bedrock principle that, once embraced, will fundamentally shift your mindset from the capricious realm of chance to the solid ground of calculated conviction. This trait is not about market timing or hot tips. It is about an inner discipline, a profound understanding that transforms uncertainty into opportunity. Are you ready to discover the true nature of this distinction and to claim your place as a master of your financial destiny? The silent anguish of chasing market trends, isn't it a familiar ache? That dopamine rush when a stock surges, followed by the cortisol spike when it plummets, mirroring a gambler's desperate hope rather than an investor's reasoned conviction. This emotional roller coaster often masks a fundamental lack of understanding of a company's true worth, leading to a paralyzing indecision or, worse, impulsive actions. We are told, perhaps, that market prices inherently reflect a company's true value. But is that truly the case? The efficient market hypothesis, while powerful, has its limitations. Behavioral biases, like the anchoring bias, often cause us to fixate on the current market price, neglecting the deeper, fundamental analysis required to see beyond the fleeting numbers. This is where the wisdom of Benjamin Graham becomes our guiding light. He taught us to discern genuine value through a three-step technique. First, master the qualitative analysis of a business. Understand its economic moat, that enduring competitive advantage, and the integrity of its management. Does the company truly have an unshakable fortress around its profits, led by stewards of capital? Second, rigorously apply quantitative valuation models, like discounted cash flow or asset-based valuation, to estimate the intrinsic worth independent of market sentiment. And third, demand a significant margin of safety before investment. This isn't just a rule, it's a profound protection, a cushion against the unforeseeable. This systematic approach transforms investment from a blind bet to a calculated acquisition, a decision rooted in understanding, not speculation. Imagine a market darling, once heralded, trading far above any reasonable estimate of its intrinsic value. A disciplined investor, armed with Graham's tools, could have identified that overvaluation using publicly available data, avoiding the inevitable correction that caught many unprepared. This technique empowers independent, informed decisions, allowing you to walk away from the crowd with quiet confidence. The investor, guided by the intrinsic compass of value, navigates the market's turbulent seas with a clear destination, while the gambler drifts aimlessly, reliant on the unpredictable currents of sentiment and chance. Which journey calls to your soul? There is a deep, philosophical wound that emerges when we question the market's fairness, isn't there? It's often compounded by incomplete financial education that promotes certainties where none truly exist. This can breed a profound distrust of financial authority, pushing us towards seemingly simpler, yet ultimately riskier, speculative plays. This is often fueled by the overconfidence bias, a subtle saboteur that convinces us of our own predictive powers over over market movements. This hubris, much like a gambler's belief in a hot streak, often leads to insufficient due diligence and a neglect of prudent risk management, leaving us vulnerable to unseen forces. Let us unpack a critical distinction. A gambler predicts a single outcome. This stock asterisk will asterisk go up. Their hope is tethered to a singular, fragile expectation. An investor, however, engages in a probabilistic assessment of a range of potential outcomes and their likelihoods. This isn't about knowing the future, it's about understanding the spectrum of possibilities. Embracing uncertainty rather than fighting it becomes a profound source of strategic advantage. Consider a practical transformation, implementing a scenario analysis framework. Here, your investment decisions are stress tested against multiple plausible future states: optimistic, neutral, and pessimistic. You move beyond single point forecasts to understand the potential distribution of returns and losses, a crucial step for wise capital allocation. This technique, deeply rooted in robust risk management principles, allows you to anticipate rather than merely react. The gambler throws dice, hoping for a specific number, their fate reliant on a single roll. The investor, by contrast, builds a robust portfolio like a diversified ecosystem. They understand that while individual components may falter, the overall system thrives through resilience and adaptation to changing conditions. This is the quiet power of probabilistic mastery, moving from the fragile hope of prediction to the enduring strength of profitable possibility. The deep-seated fear of financial loss, isn't it often compounded by an unconscious, limiting belief about wealth accumulation? Insidious short-term market narratives instill this, leading to an energetic drain from constantly chasing fleeting market trends, mimicking a gambler's pursuit of immediate gratification. Many cling to myths about getting rich quick through active trading or market timing. Yet, this expectation is often shattered by the quiet truth. The true long-term impact of seemingly small financial habits, such as consistent saving and patient compounding, dwarfs the volatile, often ephemeral gains of speculative trading. The recency bias often makes recent rapid gains appear more likely to continue than they are, drawing us into a dangerous dance. Consider the story of John Bogle, the pioneer of index investing. His journey reveals the critical importance of independent thought and data-driven analysis over fleeting market sentiment. Bogle's relentless focus on low expense ratios and the relentless power of long-term compounding directly challenged the speculative, high-fee environment of his time. He demonstrated with unwavering conviction how patience and broad, low-cost market exposure consistently beat active gambling over time. His legacy is a testament to the quiet power of waiting, of letting true value ripen. To truly grasp this, let us explore a three-step strategic finance technique to discern the genuine mechanisms of compounding. First, understand the profound simplicity of the rule of 70 for exponential growth, a quiet whisper of how time multiplies capital. Second, analyze the historical impact of dividend reinvestment versus taking cash, revealing how seemingly small choices cascade into vast differences over decades. Third, quantify the cost of impatience by comparing long-term compound returns with hypothetical short-term speculative gains. This exercise lays bare the true, almost magical power of time. Gambling is a frantic attempt to sprint to the finish line, often collapsing midway. True investing, by contrast, is a disciplined marathon where consistent pace and strategic hydration, the steady drip of compounding, ensure you not only finish but dominate the race. This is the time horizon paradox. Patience, not hurried action, unlocks anti-gambling wealth. The cognitive dissonance from conflicting financial theories. Isn't it a heavy burden? Where logical analysis suggests one action, but emotional impulses, fear, greed push us towards another. This internal conflict often leads to loss aversion, holding on to losing investments far too long, or overconfidence bias, leading to inadequate due diligence on winners. These aren't just errors. Confirmation bias and loss aversion can masquerade as conviction and prudence, hiding the truth that we are ignoring contradictory evidence or clinging desperately to failing positions. This psychological trap prevents us from admitting mistakes, from adapting to new market data, mirroring a gambler's desperate doubling down on a losing hand. Let us find healing in understanding. Daniel Kahneman, in Asterisk Thinking, Fast and Slow Asterisk, illuminates our two systems of thought. System 1, the intuitive, emotional, fast brain, and System 2, the deliberate, rational, slow brain. The key is to learn to recognize when your fast, emotional brain is steering investment decisions. When market headlines scream and your heart races, that's System 1 taking the wheel. The practice is to then intentionally engage your slow, analytical brain for superior outcomes, transforming impulsive reactions into strategic responses. This isn't about suppressing emotion, but about acknowledging it and then choosing a more deliberate path. Consider a practical transformation. Developing an investment decision journal. This rigorous system involves documenting every investment thesis, the rationale behind it, your entry and exit criteria, and crucially, your psychological state at the time. Applied consistently, this technique provides invaluable feedback, allowing for a data-driven diagnosis of your behavioral biases. It becomes a mirror, reflecting your true patterns, enabling a systematic reduction of emotional influences. The gambler is a ship without a rudder, tossed by the emotional storms of the market. The astute investor, however, is a captain with a calibrated compass and a firm hand on the wheel, navigating with deliberate intent through turbulence. This is the essence of emotional fortitude, building a psychological moat against market madness. The overwhelm from information overload, without a clear path for synthesis. Isn't it a common source of investment inadequacy? It becomes so difficult to distinguish the true signal from the ceaseless noise, pushing many aspiring investors to seek simplistic answers or, worse, to rely on gut feelings. These gut feelings often are merely subconscious biases masquerading as intuition, leading us astray. Society, too, has distorted the very image of the independent, data-driven investor, often portraying them as a reckless risk-taker or a guru with some secret, mystical knowledge. This misrepresentation fuels the belief that investing is about insider tips or hot stocks rather than rigorous, systematic analysis, thereby masking the profound power of a methodical approach. Consider the insightful work of George Soros and his reflexivity theory. While his focus was macro-driven, his approach reveals the critical importance of independent thought and data-driven analysis over fleeting market sentiment. Soros highlighted systemic risks often overlooked by mainstream analysis, demonstrating how a robust theoretical framework can guide strategic, rather than purely speculative, decisions. He saw how market perceptions could influence fundamentals, and how fundamentals could then influence perceptions in a continuous loop, a dance not for the faint of heart, but for the discerning mind. To navigate this complex dance, let us embrace a three-step strategic framework for deconstructing complex financial instruments and market anomalies. First, identify the underlying economic principles truly at play, stripping away the superficial layers. Second, quantify the key variables and their intricate interdependencies, seeking the threads that connect seemingly disparate events. And third, develop a falsifiable thesis, one that can be tested against empirical data, moving beyond anecdotal evidence or seductive market narratives. This systematic approach fosters a critical, questioning mindset, building a foundation of understanding. Gambling is often a superstitious ritual, believing in charms and luck. Investing, however, is a scientific experiment where hypotheses are tested, data is meticulously analyzed, and conclusions are drawn with systematic rigor, leading to reproducible, sustainable outcomes. This is the systematic edge, replacing fleeting gut feelings with enduring, data-driven frameworks. We have journeyed through the turbulent waters of speculation and the serene depths of true investing, confronting the quiet aches and the loud anxieties that often cloud our financial path. The distinction, once blurred by market noise and emotional impulses, now stands clear. The one trait that profoundly separates the successful investor from the unwitting gambler is an unwavering commitment to rigorous, data-driven analysis and the pursuit of intrinsic value, fortified by an unyielding emotional discipline. This is not a mere technique, it is a way of seeing, a way of being, a profound shift from speculative hope to analytical conviction. This shift is not simply about avoiding the painful sting of losses. It is about building verifiable, sustainable wealth that echoes through generations. It is about moving beyond the frantic chase of fleeting trends and embracing the quiet, enduring power of understanding. It empowers you to achieve true financial mastery, to stand firm amidst the clamor, and to make decisions rooted in profound insight rather than fleeting fear or greed. Remember the timeless wisdom of Warren Buffett: price is what you pay, value is what you get. This simple truth encapsulates the very essence of what we have explored. It is the core principle that will allow you to navigate markets with unwavering confidence, to make independent decisions, and to compound wealth not by chance, but by conscious, informed choice. This is the path to freeing yourself from the psychological traps of gambling, to finding solace in the data-driven truth, and to building a legacy of genuine financial independence. This journey is a sacred practice, an ongoing quest for wisdom that transcends superficial dogma. It is an invitation to heal the wounds of past mistakes, to restore your sense of value not in quick gains, but in enduring understanding. It is a quiet rebellion against the chaos, a commitment to clarity in a world of confusion. As you step forward, armed with this profound trait, how will you choose to redefine your financial future, not merely as a participant, but as a master of your own destiny?